A lot of international buyers assume that getting a French mortgage is mainly about income. Then they speak to one bank, get a no, come away thinking the whole plan is off the table. In reality, the bigger issue is often how the bankers assess their case. In this conversation, we break down how French banks really assess affordability, what the 35% rule actually means, which types of income count and which often don't, and why one lender may say no while another is willing to lend. So if you want a clearer sense of what you may be able to borrow, what deposit you are likely to need, and how to avoid wasting months going in the wrong direction, then this will give you a much more useful starting point. We're joined by Sharon Revol from CAFPI International. Hi, Sharon, how are you?
Hi, Jake. I'm fine, thank you. How are you?
Yeah, I'm good, thank you. Thanks for joining us. So please tell me a little bit about CAFPI and how you can help snow-only buyers in 2026.
So I'm a French mortgage broker. I've been a broker for, crikey, 22 years. It makes me sound very old, but it's very experienced in arranging mortgages for non-resident and international clients. I look after the international team at CAFPI. CAFPI are a nationwide French mortgage broker, 230 branches in France, 30,000 mortgages arranged in 2025. We're one of the leading mortgage brokers in France. And the international team is composed of 15 specialized mortgage brokers assisting our foreign international clients make their dream of owning a piece of France come true, basically.
Perfect, amazing. That aligns really nicely with our type of clientele who are usually buying in France, are non-residents and are looking to get financing and raise funds in France. So perfect. So let's get straight into it. I know I saw one of your LinkedIn posts, I think it was this week or last week, and it said, how do French banks calculate affordability? So I thought, let's jump on a video and talk about it. So yeah, the question is, how do French banks calculate affordability?
Well, in terms of how they look at how much people can borrow and borrowing capacity and how they decide what's affordable or not, it's important to realise the French lending criteria is actually set by the government. So the interpretation of that criteria may vary from bank to bank, but the French banks themselves have to stick to it. They can't just say, oh, well, that's the criteria, we're just going to go and do something else, because there are actual financial penalties involved if they do not respect the criteria set by the French government. And the regulatory body that manages all of that is called the HCSF. So banks will often talk about HCSF rules when it comes to lending. So all of that's very good, but what does it actually mean? It means one of the lending criteria here is affordability. So the French lenders cannot get borrowers into debt more than 35% of their taxable income. So how that actually translates is for every 1,000 euros you have as taxable income, your total debt-related outgoings cannot be any more than 350 euros per month. So if you earn 2,000 euros a month, you can't be any more than 700 euros in your monthly debt-related outgoings. So when they look at that, first of all, what is your taxable income? What incomes they take into consideration? And this is where working with a broker such as ourselves can make a difference. Sorry, I'm losing my glasses, because the way the banks calculate and what income they use does vary between the banks, and that's where the difference between the criteria happens. So some banks will look at your gross income, some banks will look at your net after-tax income, and other banks will look at your net taxable income, i.e. your gross income minus any social security, national insurance, etc., before tax. So that's three different bases that we've got already. They will look at your rental income if you already earn rental income. Some banks will take 70%, some banks will take 80%, some banks will take up to 90% of long-term rental income. If you have Airbnb or seasonal renting income, they don't generally take that into consideration, and most banks won't take into account dividend income either, although some banks will. So we can see already that there's going to be differences between how banks will look at your application. So if you go for a really strict bank that work on your net taxable, well, your after-tax income and 70% of your rental income, then you're going to get a completely different outcome from a bank that will look at your gross income and 90% of your rental income. So that gives you an idea of why there can be such vast differences between banks. So that's the affordability of the mortgage. When they look at the affordability, they also look at things like how much money you have left over every month once you've paid all of your debt-related outgoings. They look at how much savings you will have after you've purchased. If you're buying a second home in France, banks will expect you to have leftover savings, rainy day savings, as well as be able to put some money as a financial security in a bank account with them, so that they're not relying on you transferring money every single month to pay your mortgage. What else do they look at? They look at your age. Are you going to retire whilst you've got the mortgage? They look at what job you're in. Do you have, for example, commission-based income? And if you do, they'll be looking to see if that's been regular for the last 3 years. Some banks will take 100% of that income. Some banks will take just 50%, and some banks won't take any of it. So the affordability criteria can be quite vast, but once it's set, they can't kind of go up to 50% debt to income ratio just because you have more leftover income.
Understood. So it sounds like to me, all the bits that you've said there is can be, there's a spectrum, right, to I guess affordability and the different kind of banks and the lending criteria. So how do clients navigate that? That's probably the reason why they should use a broker, right?
Yeah, absolutely. Because as a broker, we have an overview of the market and every bank's criteria. So if you were going to each bank on your own, you wouldn't understand what their criteria is, and you would just have one banker saying, well, yes, you can do this. So imagine if one banker said, well, you could borrow 200,000 euros, when actually your budget was 300,000 euros, and you'd be shooting yourself in the foot, so to say, because you actually truly don't know what your budget is across the market. And as a broker, we do have that overview and experience. So saving you time and money, of course, on the mortgage deal, but also giving you everything you need to make an informed decision when you're looking to buy a property in France. I spoke to a lady today on the telephone. She'd been to see a bank directly. They just said to her, no, I'm sorry, you can't borrow. And she had absolutely no idea why she couldn't borrow. So we actually went through her application together, explained, how it worked, looked at her finances and came up with a plan. So yes, actually she can't borrow today, but she knows what she needs to do to get herself into a position to be able to borrow in 6 months and a year's time. Buying a property in France for many people is a long-term plan, and it's something that you prepare for. So by speaking to somebody who has the full market experience, other than, of course, you're getting you the best deal, it also means you're able to get yourself in the best possible position to be able to buy.
Yeah, that makes complete sense. That really resonates with me, because I know obviously here at Snow Only we deal with buyers that are right at the start of their search up until people that are going out to resort like sort of next week, and we things can take a while to get across the line. I remember a few months ago, I think we sent this buyer over to you actually. He came through the site. He said, look, I've been trying to go through the French banks directly for the past 12 months. I haven't really got anywhere. They just said no to me at the end, and I'm back to square one, and I've kind of wasted 12 months time. And then I think I'm pretty sure that we connected them with you, and since we've been working on that client in the background. So yeah, super useful to have those connections and to be able to come up with a plan instead of just getting a straight no. we can't do this. Right? Yeah, for sure. Super helpful. Cool. So how much down payment is not, most of our buyers are non-residents. What are we talking for an average down payment for a French mortgage?
So it's always going to be based on the property price, excluding any fees, any furniture, etc. So down payment will also depend on which country you live in, because there can be some variations. Typically, it's going to be between about 15 and 30% of the property price, excluding any fees. And some banks may also require an additional financial pledge or savings to be put in with the bank. And that can vary between 12 months mortgage payments up to 15 or 30% of the property, well, of the mortgage amount, depending on your profile. Some banks may offer you a really good deal if you're able to work with them a little bit more, and that's things that we work with you as brokers, because it means based on your expectations, if, for example, if you had more of a working relationship with a bank, you might be able to do less deposit, maybe 100% finance, but you need to put more savings in with the bank. So that's something we look and discuss with our customers so that we're able to find them the best possible deal. But for everybody, generally across the board, you'd be looking between 20 and 30% down payment.
Last question here. Current maximum debt to income ratio. What is it? A one size fits all? How does that work?
It's 35%. We can't go above it because of the HCSF regulations. So that is going to be 35%. And as I was saying earlier, it depends on how the banks calculate what your net income is, what your income is, etc. But I'm afraid we can't get around the 35% unless we go outside of France. Okay. There's always an exception. If we go, to example, and do a mortgage in Luxembourg, then we can go over 35% debt to income ratio, but we're going to be looking at high net worth individuals, possibly putting a minimum of 500,000, €1 million in the bank. And that, in those cases, we can go above 35% debt to income ratio, even if the customer wants a reasonably small mortgage. With interest rates being so low, it's good to leverage. It's what all of the bankers do when they buy with a mortgage. When they buy a property, they buy with a mortgage to have maximum leverage to be able to work their investments. If you have life insurance with the mortgage as well, which is generally the case in France, if anything happens to you, that mortgage is paid off and your savings and investments remain intact. So you're using the leverage of a mortgage to finance your investment whilst planning for the future for your family and also keeping your savings intact.
Amazing, perfect. Well, let's wrap it up there. Sharon, as always, pleasure having you on here. Really appreciate you jumping on. And if anyone has any questions regarding affordability, you can reach out to me directly or to Sharon. And hopefully we can help you get a French mortgage for your French property purchase. As always, like and subscribe helps the channel massively. And catch you on the next one. Thanks, Sharon.
Thanks, Jake.